Hi, welcome to Learn with Shri. This is the first video on this topic, leverages. I'm going to spend the first few minutes to talk to you about the examination perspective of this topic, and then I would be going in for the topic introduction. If I look at the FM exam, which is for 60 marks, I can generally expect one question for around 10 marks to come from this topic, leverages. So we are talking about 1/6 of the exam paper, 10 out of 60, 1/6 of the exam paper from this topic, leverages. I want to tell you two important points about this 10 marks. The first point is that the questions that you can expect from this topic, these questions are fairly predictable. These questions are fairly predictable. This is the first point. Now, what I mean by this is that if you look into the past exam question papers and you analyze the questions that come from this topic area, you will understand that the questions get repeated. And there are just a few type of questions, and these keep coming again and again in the exam as far as I've observed the past exam question papers. So if you do this exercise of observing the past question papers, you can kind of predict what type of questions you can expect in your exam. So that is what I mean when I say the questions are fairly predictable. And yet another thing is that the questions are very easy as well. So I have not seen any difficult or complex mind-blowing questions coming from this topic area. So all of these questions are pretty easy. So these are two important things about this 10 marks out of your 60 marks. Yet another important point I want to tell you all is that this topic is absolutely easy to prepare. It's very easy to prepare. So although this occupies 1/6 of your exam question paper, when I talk about the preparation aspect of this, this is very easy, right? There are just a few concepts and these are very easy to grasp, and these are the concepts that also get tested in the exam. So if I look at this topic from the exam preparation perspective, it's easy, and also from the exam perspective, it's also easy again. So the reason I'm saying this is that any student preparing for his or her FM exam must definitely focus on this topic so that they can completely score this 10 marks. Yeah. So that's about this topic from an examination perspective. So now I'm going to go for the introduction of this topic. So I'm going to be taking two examples for the introduction. Both of these examples are meant to introduce the topic at a high level. Once these two examples are over and we get a broad overview of what we are going to be discussing, then I will be going in for problem solving, and in the first problem that we will take up for discussion, I will be introducing the topic even further. So these two examples that we are going to take now, example 1 and example 2, both of these will only introduce the topic at a very high level. So from a 30,000 feet, you will be seeing what we have to study in this topic. And then we will slowly start descending as we go into each one of the problems that we are going to be looking into. And once we finish solving all the problems that we need to do in this topic area, we will get a complete understanding of this topic, leverages. So now I am going to go for example 1. I'm going to go for example 1, and this example 1 is going to introduce at a very high level this concept of leverages. So let us assume that you are planning to purchase a house. Let's assume you're planning to purchase a house. Let's say this is the house you're planning to purchase. The first question that comes to our mind is, what is the cost of the house? Let's assume in our simple example that the cost of the house is 1 crore, 100 lakhs. The next question that probably comes to our mind is, how do I finance this purchase? That is the next question. Now, what do I mean by this question? How do I finance the purchase? I'm basically asking myself, where do I get money to buy this house? There can be different sources from which I can raise finance for this house. Probably I put in my savings, or probably I go to a bank and raise finance from the bank, or probably I go to a friend of mine and take money from him and put it in the house. There are probably different sources from which I can raise finance. In our simple example right now, example one, in this case, I'm going to assume a simple financing structure. Let's say out of this 1 crore that I need for this property, let's say 50% of this 1 crore, basically I'm talking about 50 lakhs here. This 50 lakhs comes in the form of savings. Let us say I have my own money and I'm putting in my own money to the extent of 50 lakhs, which is 50% of the property cost. The balance 50%, let us assume that, okay, this is also 50 lakhs, and let's assume that this 50 lakhs comes in the form of a bank loan. So this is the simple financing structure I have assumed in my example to buy this house. Right? There can be different other sources as well, but I am assuming this to be the simple financing structure for this house. So let's say I put in 50 lakhs of my savings, take a loan of 50 lakhs, and together with 1 crore I buy the house. And as soon as I buy the house, I'm going to be drawing up a balance sheet for myself to capture the house investment. Okay, so this is the liability side, this is the asset side. So I'm going to go to the asset side and I'm going to put the asset that I've just bought, which is the house, and obviously it's going to be carried at a value of 1 crore. This is the cost at which, this is the price at which I bought the house. Now, how was this house made possible with money, and from where did this money come from? Savings and bank loan. So that is what I am going to put in the liabilities side. So when I come to the liabilities side here, I got 50 lakhs in the form of a bank loan. So that is something I would write here. And I also got the other 50 lakhs from my own savings, and I'm going to call that equity. I'm going to call that as equity. Why do I call it equity? Because equity refers to owner's money. Equity refers to owner's money. And here I am the owner of the property and this 50 lakhs is my savings. So that is why I call this 50 lakhs as equity. Loan is basically a type of borrowed money. So borrowed money is what we can also call as debt. So now I have this balance sheet which has just captured, it's a simple balance sheet, it has just captured the purchase of the house. Fine. This is it. I have bought a house and I have drawn up a balance sheet to capture the house purchase. Let us say some time passes by. Let us say some time passes by. Let me assume 1 year passes. 1 year passes, and there is a change in the property value. Let us say the house value increases to 1.2 crores. Let us say the house value increases to 1.2 crores. When I bought it, it was 1 crore, and in 1 year time, let's assume the house value goes to 1.2 crores. Basically, we are talking about 1 crore becoming 1.2 crores. So 1 crore to 1.2 crores, let's say we are talking about, we are actually talking about 20% increase in the house value. 20% increase in the house value. Now what I want to do is I want to capture this in the balance sheet. Basically, I want to redraft my balance sheet and carry the house at the revised value of 1.2 crores. So let's see how that has to be done. So draw up the balance sheet once again. and in the asset side make the house sit here, but now the house is going to be sitting in the asset side not at 1 crore but at 1.2 crores, which is 1 crore and 20 lakhs. This is the value of the house. Obviously, I need to populate the liability side also with numbers. So I'm going to have the loan value here. Loan is the debt, which is the borrowed money. And this is going to be 50 lakhs. This is going to be 50 lakhs. Now, this number does not change. This number does not change because this is the number that I originally obtained from the bank, and this loan in the liability side indicates how much I owe the bank. So since I initially borrowed 50 lakhs, that is what I owe the bank, and what I need to repay to them is also the same 50 lakhs. See, here I am ignoring interest and the discussion around interest, right? When I take a loan, I obviously need to pay interest on that. But that's a financing cost, and that cost is something that I'm ignoring in my discussion here. This is just a simple example to get introduced to this concept of leverages. So we are basically talking only about the main money obtained, which is basically the principal portion of the loan taken. So let's assume that we are talking only about that. Right? In a real life discussion, obviously interest is also going to be something relevant, but I'm not going to be assuming that I'm not going to be considering that in my example here. So when I talk only about the principal portion, what is due from my side to the bank, what I owe the bank is going to be 50 lakhs. That is not going to change, and hence this number is also not going to change. So when I go to equity here, obviously for my balance sheet to actually balance, I need a number of 70 lakhs here. I need a number of 70 lakhs. So now my balance sheet totals at 1 crore and 20 lakhs. 1 crore and 20 lakhs. Now, this is obviously owner's investment. Let us see what will happen if I sell the house now. Let's say at this moment when the house has this value of 1.2 crores, if I sell the house, what will happen? I will get 1.2 crores of money, and from this 1.2 crores of money, I need to pay the bank 50 lakhs of money, and after paying the bank, I am left with 70 lakhs, which is all for me, So I put in 50 lakhs of my money. As the owner, I parted with 50 lakhs of my money, and in 1 year time, I got back 70 lakhs. So I can say my investment, owner's investment, which is the equity, has increased from 50 lakhs to 70 lakhs. So I put in 50 lakhs, now my investment is worth 70 lakhs. In other words, if the house is sold, I will be able to realize 70 lakhs. I'm going to spend some time now to analyze the numbers and try to understand what has happened, right? When the property value has increased to 1.2 crores, or in other words, the property has appreciated, the property has appreciated by 20%. The property has appreciated by 20%. When this has happened, I want to analyze what has happened because of that. Analysis. This analysis is very important because it is this analysis that will slowly take us to the concept of leverages and make us understand what is going on. So from that perspective, this analysis is very important. So I'm going to spend some time on this analysis. So first point, property value increased by 20%. 1 crore to 1.2 crores. What happened to the equity value? Let's see what happened to the equity value. When I say equity value, again, let me write it once more. It is the owner's investment. What happened to the owner's investment value? That went up from 50 lakhs to 70 lakhs. That went up from 50 lakhs to 70 lakhs. So basically here I am talking about a 40% increase. 50 growing to 70, it is a 40% increase. So let me put that here. Equity value increased by 40%. So the property value increased by 20% and the equity value increased by 40%. Isn't this surprising? If the property value increased by 20% and the equity value also increased just by 20%, then that's probably something that's easily relatable to, right? But now that's not what has happened. The property value has increased by 20%, but the owner's equity value has increased by 40%, double of what happened here. 2 times of 20%, that is 40%. Why has this happened here? Now, this has happened because there was something else called as debt value, and this did not change. This did not change. Debt value did not change. When the property appreciated in value from 1 crore to 1.2 crores, the bank never came to us and said, look, the property value went up. Please allow me to participate in the increase in value. That is something that the bank never told us. The bank gave us 50 lakhs. The bank gave the owner of the house 50 lakhs as a loan, and the bank is expecting only 50 lakhs back. We are ignoring interest, obviously. The bank is expecting only 50 lakhs back. So the bank is not intending to participate in the appreciation of the property value. So what happens is, to make the property come in place, finance was required, and for that the bank also gave money. So if you look at the financing of the property, bank also gives extends finance. But if you look at the increase in property value, the bank never steps in to share that. So bank comes in to make the property a reality. Basically, bank comes in to give money for the property purchase. But when you talk about the property value increasing, the bank never comes inside. It is only the owner who completely takes advantage of the increase in the value of the property. So since the property value increased and the debt value did not change, that also did not increase, you can see that you have a 40% increase in equity value. I would like to call this as a magnified impact. I would like to call this a magnified impact. Now, why am I calling this magnified impact? Because if you ask me a question, right, or if I ask myself a question, why did equity value change? Then I would say equity value changed because there was a trigger. There was a trigger. And what was the trigger? The trigger was house value change. When the house value changed, the equity value also changed. So the house value change was the trigger. But this trigger has a magnified impact because 20% house value change has led to a 40% change in equity value. So that is why I use the word magnified here. That is why I use the word magnified here. So you can see a magnified impact. You can see a magnified impact. And this magnified impact is very important. And this magnified impact is what we are going to be studying in this topic called leverages. Now, why did this magnified impact happen at all? This is because of debt value not changing. So I would say the contributor to the magnified impact, which is also what we call as the leverage effect. The contributor to the magnified impact was this debt. This was the contributor to the magnified impact. And what is so special about debt? I will say debt is fixed in nature. Debt is fixed in nature. It doesn't change. right? It doesn't change. Just like in this case, the 50 lakhs remain to be 50 lakhs, debt value will not change, right? So since debt is fixed in nature, this nature of being fixed, that is what has contributed to the magnified impact. So in our study, we are going to be focusing on things that have a fixed nature, things that have a fixed nature. That's going to be very important in our study. Okay, so we bought a house, we saw the property value increasing, and we saw a magnified impact on equity value, and we concluded saying that the magnified impact was because of debt, which has a fixed element or which is fixed in nature, and we said this magnified impact is also called as the leverage effect, right? And we said this is what we are going to be mainly discussing about in this topic. Okay, fine. What am I going to do next? I'm going to take the same example and discuss little further by looking at what's going to happen if I change the numbers in another way. So let us say instead of the house value increasing, let us say the house value reduced. Instead of the house value increasing, let us say the house value reduced, and I will say let's assume property value $80 lakhs. So basically 1 crore to 80 lakhs. Now this is also a 20% change. This is also a 20% change, but this is now a 20% reduction in value. If this happens, let us see what is going to happen to our equity value. So in the previous discussion, we studied the relationship between property value increase and equity value increase. Now we are talking about property value reducing, and we will see what impact that would have on the equity value. So for that discussion, I'm again going to draw up the balance sheet. Right? I'm going to redraft the balance sheet with and put these numbers into place. So now the house will be there on the asset side, and that is going to be carried at 80 lakhs because that is the revised value of the house, and there is going to be a loan value here, and that loan value is going to be 50 lakhs. That is not going to change. Yes, so debt, we had a lot of discussion in the previous case understanding why this value will not change. Now obviously that means the balance here has to be 30 lakhs for us to get, let's say here. So what happened? Sorry, 80 lakhs. So this is equity, owner's investment, 30 lakhs. Now, equity value has also reduced because it was originally 50 lakhs when I bought the house, and now equity value reduces to 30 lakhs. Equity value reduces to 30 lakhs, and this is basically 50 lakhs to 30 lakhs, and that is a drop of 40%. That is a drop of 50 to 30. So there is a reduction of 20 lakhs. 50 reduces to 30 lakhs. So there is a reduction of 20 lakhs, and that is 40% reduction. So what we can see here is house value reduces by 20% and equity value reduces by 40%. So here again you can see there is a trigger. The trigger is the house value changing, and you can find the impact of this trigger on equity value because equity value also changes, but you will see again this magnified impact. You will see again this magnified impact. Why magnified? Because 20% trigger has led to 40% effect. So that is what I call again as the magnified impact. So here again you can see the magnified impact, and here again the reason that we would attribute to this magnified impact is this guy here called debt. this person called debt, loan. This is the contributor here also to the magnified impact, because when the house value reduces, there is a drop, and that drop is not shared by debt. The drop is completely absorbed only by the owner. The property was made possible by both sources of finance, but when it comes to change in the value of the property, it's only one guy who steps inside, which is the owner. So here again, the reason for the magnified impact is debt. But here we are talking about reduction, because the trigger was also a reduction in house value. So what we understand from putting both these discussions together, the first one where property value increased, and the second one here when the property value is reducing, house value is reducing. If I put both these things together, what I understand is you will have a trigger if the house value changes, and there is an impact on equity value, and that impact is a magnified impact, and in the same direction you can see this magnified impact. If house value increases, equity value increases by much more than that percentage, and if the house value reduces, equity value also reduces by much more of that percentage, right? So the direction is the same, but you will see a magnified impact, and in both cases the reason for the magnified impact is debt, because debt does not change. This value does not change, so it does not participate in the drop or increase in the value of the house. So here again the conclusion is there is a magnified impact that is called as leverage effect, and this leverage effect is because of debt. So the reason I had both the discussions was because I wanted to observe what is going to happen to equity value, and I wanted to zero in on this magnified impact, talking about both increase in the property value and also decrease in the property value. In both cases I wanted to zero in on this magnified impact to take this further for discussion. Okay, what am I going to do next? I'm going to take the same example, and I'm going to change the financing structure and see what is going to be the magnified impact, if at all, right? So basically what am I going to do now? I'm going to assume a different financing structure. Earlier, this property, we said this property would be financed 50% from equity and 50% from debt. The property was had a cost of 1 crore, and we said 50 lakhs comes as savings and 50 lakhs comes in the form of bank loan. That is what we said earlier, but now I'm going to change that financing structure. I'm going to adopt a different financing structure, and with the different financing structure, let us see what is going to happen here. Would this be there at all? If it is there, will there be any difference in what I'm going to be seeing? All that we will see if we change the financing structure. So I'm going to have extend this example one a little further, and I'm going to change the financing structure. So we are still in example one. But we are just changing the numbers and a lot of things to have a conclusive understanding. So for clarity, let me put that here. We are still in example one only. Change in financing structure. So the house value of 1 crore, now let us assume that this house value has been funded as 80% in the form of equity. This is 80 lakhs, and this is in the form of equity. So when I say equity here, I mean owner's money, and here we have 20%, and this 20% is in the form of debt. This 20% is in the form of debt. Okay. With this financing structure 80-20, I'm going to draft a balance sheet. So let me put the house here. The house is carried at 1 crore because that is the value of the house, and I have debt here, which is basically the loan, and that is going to be 20 lakhs, and I have equity here, and that equity is going to be 80 lakhs. That equity is going to be 80 lakhs. Now, assume that 1 year passes and we have the same two scenarios. Both the scenarios, property value is going to change, but in one we'll assume an increase, in another we'll assume a decrease. So here let us say 1.2 crores and here let us say 80 lakhs. So basically we are talking about 20% increase here and we are talking about 20% reduction here. Scenario 1, scenario 2. The same two scenarios we had in our discussion just a little while back. We are going to have a discussion now also, but here we are going to capture this financing structure, which is the revised financing structure. Let us see what happens. So let's go first to scenario 1. Let us first go to scenario 1. How is scenario 1 going to look like? I'm going to again draw a balance sheet and capture the facts. Now, the house in scenario 1, this is basically 1.2 crores. So the house is now going to be carried at 1.2 crores. Yes. You can see the loan value to remain at 20 lakhs. I use the word loan debt interchangeably. Yeah. And you will have equity here, and this equity would be 1 crore, basically 100 lakhs. And now you have this balance sheet total of 1.2 crores. Fine. Let's analyze what has happened. House value has increased from 1C to 1.2C, and we are talking about 20% increase. Let's again understand the impact on equity value. It has gone up from 80 lakhs to 1 crore. 80 lakhs to 1 crore. This is a 25% increase. So 80 lakhs becoming 1 crore is a 25% increase. Here again, you can see the magnified impact. Here also, you can see the magnified impact. Why do I say that? There is a trigger. There is definitely a trigger because house value changed. And the trigger has an impact on equity value because equity value also changed, but the percentage change is not same. Trigger 20% change and impact on equity value 25% change. So there is a magnified impact. There is definitely a magnified impact. So there is definitely what we call as a leverage effect. We do have that. Here also, the reason for this magnified impact is debt, because this was 20 lakhs in the previous previous balance sheet, and this is 20 lakhs here also. So debt does not change. So because it does not change, it did contribute to the magnified impact. But if I put this with the previous discussions that we had, you can observe that though there is a magnified impact, the magnified impact is not as high as what you saw in the previous case, because previous case we saw 40% effect. But this case we are able to see only 20% effect. This case we are able to see only 20%, I'm sorry, not 20%, 25% effect. This case we are able to see only 25% effect. So though there is a magnified impact, the magnified impact has reduced from 40% effect to 25% effect. This is an important observation I want to make. Why has the magnified impact reduced? The magnified impact has reduced because the proportion of debt financing has also reduced. In the previous case, my debt financing, let me call debt financing. In the previous case, my debt financing was 50%. 50% of the house value came in the form of debt. Debt financing was 50%. Now in this case, if I see, my debt financing is not 50%, my debt financing was only 20 percentage, because out of 1 crore, 80 lakhs came in the form of equity. It was only 20 lakhs that came in the form of loan. So you can see that the proportion of debt in the total financing has reduced from 50% to 20%. Since the proportion of debt has reduced, the magnified impact has also reduced. It is logical to understand, because what what contributes to the magnified impact? It is debt. So higher the proportion of debt financing, higher the magnified impact, and lesser the proportion of debt financing, lesser the magnified impact. So here, since the debt financing proportion is lesser compared to the previous case, I can observe that the magnified impact has also reduced. Now, I want to make the same observation also in scenario 2, when the property value has decreased to 80 lakhs. From 1 crore it has decreased to 80 lakhs. Let me again redraft the balance sheet, and I will carry the house here at 80 lakhs. The loan value is going to be 20 lakhs. Equity value is going to be 60 lakhs now. So you can see that we have a total here of 80 lakhs. Great. Now let's look at the analysis part. House value reduces by 20%. How? 1 crore to 80 lakhs. If I look at equity value, this also reduces. This reduces from 80 lakhs to 60 lakhs, because in the previous case, when I initially drew up the balance sheet, it was 1 crore, 20 and 80, right? So from 80 lakhs, the equity value here reduces to 60 lakhs. So this is a 25% fall in my equity value. So now if I sell the house, I will get 80 lakhs of money, pay off the bank 20 lakhs, and you get 60 lakhs to keep with you. So equity value has reduced by 25%. So that means you will still have the magnified impact here, because the trigger was 20% and the impact you see is 25%. Still you have the magnified impact, and that is still because there is some debt in the financing. So the moment there is some debt in the financing, you will definitely see this magnified impact. But here also you can see that it was only 25% drop as against 40% drop in the previous case. The previous case, when house value reduced by 20%, equity value reduced by 40%, but here again it's only 25%, because same thing that I told in just a little while back holds true here also. The proportion of debt has reduced. In the second financing structure, the proportion of debt is only 20%. So higher the proportion of debt in the financing structure, higher the magnified impact, and lesser the proportion of debt in the financing structure, lesser is the magnified impact that you can observe, right? So if I put scenario 1 and 2 with the previous discussion we had, basically the first type of financing structure and the second type of financing structure, if I put both of these things together and I want to draw a conclusion, what I would probably say is that there is a magnified impact if you have a fixed source of financing, which is debt in our example. This magnified impact is what we call as the leverage effect, and this has a direct relationship with the proportion of the fixed source of finance, the proportion of debt. Higher the proportion, higher the impact, lesser the proportion, lesser the impact. So with this example 1, we have understood about what we mean as the leverage effect and what is the contributor. Right? In our example, it was debt which was the contributor, and let me again re-emphasize what is very important about this debt that we discuss is this fixed aspect. That is only important. So anything which has a fixed aspect is expected to cause something like a leverage effect here, right? So the trigger could be something, you could see the impact on something else, but if the impact has to be magnified, then there must be something which has a fixed aspect here. So that is probably the take home that we can take from example 1, where we looked at one type of financing structure, and then we also looked into the second type of financing structure, right? So this was the first example which made us gain an entry into this topic leverages, and made us also understand this concept at a very high level. But this example 1, was from a balance sheet perspective. So I was talking about financing structure because this example was from a balance sheet perspective. So we have understood the concept of leverage from a balance sheet perspective. But before I go to problem number 1 and the other problems, I want to take example 2, which again introduces leverage from a P&L perspective. From a P&L perspective, I want to introduce this topic called leverage. So example 1 is from balance sheet perspective, and example 2 is from P&L perspective. And once we are done with example 2 also, then we are all set to go for the problems where we will start understanding a little more of leverages, and then we are good to go, right? So that's the plan. So the next example we are going to see is going to be example 2, where I would be talking about this magnified impact and leverage effect from P&L perspective, but that's going to be in the next video, right? Thank you so much for watching this video, and please do subscribe to my YouTube page, Learn with Stream, and I hope you always enjoy the learning experience. Thank you.